Welcome back to Financial Foresight, the podcast where we break down complex financial concepts to help you secure your future. Today, we're diving into a topic that's become a cornerstone for modern investors: index funds. Joining us is Maria Stevens, a renowned financial advisor and index fund enthusiast. Maria, thank you for being here today.
Delighted to be here. Index funds are a fascinating topic, and I'm thrilled to help demystify them for your listeners.
Let's start with the basics. For our listeners who might not be familiar, what exactly is an index fund?
Great question. An index fund is essentially a type of mutual fund or exchange traded fund that aims to replicate the performance of a specific index, such as the S&P 500. By investing in an index fund, you're essentially buying a small piece of all the companies within that index, which provides broad market exposure.
That makes sense. So, why have index funds gained so much popularity over the years?
Index funds have gained traction for several reasons. They're typically low cost, offer diversification with minimal effort, and historically, they tend to outperform the majority of actively managed funds. This makes them an attractive option for both novice and experienced investors looking to maximize returns over the long term.
Interesting. You mentioned they're cost educative. What specifically makes index funds cheaper compared to other investment options?
The primary factor is their passive management style because index funds simply aim to match the holdings of an index. They require less frequent trading and fewer resources, which cuts down on management fees. This passivity translates into lower costs for investors, often making fees significantly less than those of actively managed funds.
That's a major advantage. But if they're passively managed, how does one choose the right index fund to invest?
It boils down to defining your investment goals and risk tolerance. If you're looking for broad market exposure, a total market index fund might be appropriate. If you prefer targeting specific sectors or geographies, there are index funds designed for those purposes too. It's about aligning your choices with your financial goals and comfort with market fluctuations.
Makes sense. Now, let's talk about performance. How do index funds generally perform compared to actively managed funds?
Over the long term, studies have shown that index funds tend to outperform the majority of actively managed funds. This is because even the best fund managers can struggle to consistently beat the market after accounting for fees. Index funds, by mirroring market indexes, usually perform well during market upswings and minimize transaction costs.
Given this performance history, is there a downside to investing in index funds?
Like any investment, index funds have their limitations. They're not immune to market downturns since they mirror the market. During periods of high market volatility, an index fund will experience similar fluctuations. However, their diversified nature often mitigates the impact of individual stock volatility.
That's an interesting point. So, for someone new to investing, what would you recommend as a starting strategy with index funds?
For beginners, a potential strategy could be dollar cost averaging. This involves regularly investing a fixed amount into your index funds, whether the market is up or down. This strategy helps hedge against market volatility and ensures consistent investment growth over time. Pairing this with a diversified index portfolio tailored to your risk tolerance can provide a solid foundation.
Dollar cost averaging, that's smart. Lastly, are there any common misconceptions about index funds that you often encounter?
Absolutely. One common myth is that by being average, index funds are uninspiring or incapable of high gains. In reality, while they track the market average, the market itself can deliver substantial returns, especially over the long haul. Another misconception is that they eliminate all risks, but as mentioned, they're still subject to market risks.
Those are important clarifications. Thank you, Maria, for breaking down index funds so clearly. Any parting advice for our listeners considering index fund investing?
Certainly, start with clear goals, remain patient, and focus on the long term horizon. Resist the temptation to repeatedly check prices. Compound growth thrives best undisturbed. Each market dip or surge is part of the larger economic cycle, so staying the course can really pay off.
Powerful insights, Maria. Thanks again for joining us and sharing your expertise on index funds. For our listeners, remember, investing is a journey, not a sprint. Stay informed, and as always, happy investing.
Thanks for having me. Happy investing to all.
Now, Maria, I'd like to ask your thoughts on the growing trend of socially responsible investing. How does this relate to index funds, and should investors be considering it as part of their strategy?
That's a great question. Socially responsible investing, or SRI, is increasingly popular, especially as more investors become aware of environmental, social, and governance factors. Many index funds now specifically focus on SRI, allowing investors to align their portfolios with their personal values without sacrificing diversification.
So, are these SRI-focused index funds significantly different from traditional ones in terms of performance?
Interestingly, research has shown that socially responsible index funds often perform just as well as their traditional counterparts. It's all about the quality of the underlying companies. When you select indices that screen for strong ESG principles, you often end up with resilient, forward thinking firms that can thrive in changing economic conditions.
That's reassuring for those wanting to invest more ethically. Could you give us an example of how one might incorporate this into a broader investing strategy?
Certainly. Let's say you have a balanced portfolio. You might designate a portion specifically for SRI index funds. This way, you uphold broad market exposure and diversification while also supporting companies fostering positive global impact.
Another emerging trend is the rise of robo-advisors. They often recommend these diverse index funds. What should investors know about using robo-advisors compared to traditional financial advisors?
Robo advisors can be a cost effective and efficient way to manage investments, especially if you're just starting. They use algorithms to construct portfolios and can be great for sticking to disciplined investment strategies.
How do they handle market volatility compared to a human advisor?
Robo advisors follow preset strategies and maintain composure during market fluctuations, which can be advantageous. However, a human advisor brings personal insight, especially in times of extreme market conditions. Some investors prefer the human touch for its personalized guidance and emotional reassurance.
That makes sense. Given everything we've discussed, are there any final tips you'd give our listeners trying to navigate the world of index funds?
Absolutely. First, understand your financial goals and risk tolerance, which are pivotal. Second, choose funds that align with these goals. Keep costs low and always watch out for those hidden fees. Finally, stay informed, but resist overchecking your portfolio. Remember that patience usually wins in the long run.
Valuable advice indeed. It's been insightful today, Maria. Thank you for deepening our understanding of index funds and empowering investors with the knowledge they need.
Thank you for having me. It's always a pleasure to share insights that can demystify investing for everyone.
Thank you. And listeners, continue to educate yourselves, invest wisely, and enjoy the journey. Until next time, take care and happy investing.